Welcome to our reading on income taxes. Now, a bit of a health warning in front of this one. This, I think, is probably one of the hardest areas in the Level 1 syllabus to get your head around. For example, if you are doing an accountancy qualification, you don't come across things like deferred tax until some of your final studies. And yet here we are in the CFA syllabus expected to understand it straight away. So what I would say here is get the basics. Understand the basics of deferred tax and then move on. Don't at this stage worry about all the minute detail here. You'll end up destroying your brain. You probably won't understand it anyway, and it will take so much time that you'll miss out on other studies. So take some time on it, but don't spend too much time studying. You won't get the payback in the exam. You don't tend to see tons of questions on this particular area. Okay, let's get stuck in. Let's see what our first LOS is. So our first LOS says describe the differences between accounting profit and taxable income and also define key terms. So we can see here that we've got our tax returns, otherwise known as our tax reporting, and our financial accounts. So in our tax reports, we've got our revenues. Notice it's the same revenue figure in our tax returns and our financial accounts in this particular example. However, they could differ. We've got tax allowable costs in the tax returns. Now, the idea is in the tax returns, they use something called modified cash accounting. It's not quite cash accounting, i.e. recording transactions when cash flows are paid and received, and it's not quite accruals accounting that we see in the accounts. It's a kind of halfway house. The idea here is they don't like the level of subjectivity that accruals accounting has in the financial statements. Subjectivity means you could use that to affect your cost base, and if you affected your cost base, you could affect your profits, and if you affected your profits, you'd affect the tax that you paid. Tax authorities clearly don't like that, and therefore they use modified cash accounting that essentially removes subjectivity in judgment. So we take our revenue, less our tax allowable costs, 10,000 less 8,000 to give us our taxable income. Taxable income is going to be the figure on which we're assessed in our tax return. So we're going to pay tax on a profit of $2,000. So the tax authorities take the statutory tax rate, in this case 30%, multiply it by the taxable income to get tax payable. This is what we owe the tax authorities. So we owe the tax authorities in this case $600. Let's turn our attention to the financial accounts. So we've got our sales figure here of 10,000. We've then got our accruals-based costs, and notice in this case they're 5,000, very different from the tax allowable costs, giving us pre-tax income. We then get our tax expense. Now notice our tax expense is made up of two elements here. It is made up of tax payable, i.e. the $600, but we've also got then change in deferred tax. Essentially, if you have an increase in a deferred tax liability, that's going to increase the tax expense. An increase in a deferred tax asset, that's going to decrease the tax expense. Okay, so in fact, we're seeing 1,500 here. So what we're saying is 600 of that is to do with the tax payable. 900, therefore, must be due to changes in deferred tax. Okay, now what causes this deferred tax? Now if you look at the top of the slide, we've got these sources of difference where we talk about temporary timing differences and permanent differences. It's the temporary timing differences that cause deferred tax. What is a temporary timing difference? Well, it's when the same amount goes through the tax returns and the accounts, but just in different periods. A permanent difference is when something goes through the accounts but never goes through the tax returns, maybe because it's not tax allowable or vice versa. So temporary timing differences are what cause deferred tax. Same amount in total going through both the tax returns and financial accounts, just in different periods. Okay, so let's have a look at some of these key terms. Taxable income, well, we saw this was in the tax return. This was the amount of profit that was actually subject to taxes. Tax payable was the amount of tax that we actually owed the tax authorities, in other words, statutory tax rate times your taxable income. Income tax paid would be the actual cash flow that we paid the tax authority. Remember, taxes payable is what we owe them. It doesn't necessarily mean that we've paid them. So income tax paid is the physical cash flow that would appear in your cash flow statement. Tax loss carried forwards. Well, this really says, well, look, if taxable income is positive, we know that we're going to have taxes payable, i.e. we're going to owe the tax authorities. So if taxable income is negative, does it mean the tax authorities will pay us? And the answer, of course, is no. But what you do get is a tax loss carried forward. So if you have negative taxable income, i.e. taxable losses, what you can do with those is take those losses and offset them against future positive taxable income and pay less tax in future periods. And that's known as a tax loss carried forward. Tax base, we're going to actually look at this in some detail in a further reading, is the amount of asset or liability that is used for tax reporting purposes. We're going to make a clear distinction between carrying value, what appears in the balance sheet, and tax base, what we're going to use for our tax returns. Accounting profit. Well, we know accounting profit. Essentially, it's our pre-tax income, our earnings before tax. It's the sales minus the accruals-based costs. Now, here's our income tax expense. Remember, we said it does take tax payable from the tax returns, but then it's going to add on any increases in deferred tax liabilities and subtract any increases in deferred tax assets. And of course, if a deferred tax liability goes down, you'd subtract it. If a deferred tax asset goes down, you'd add it. So tax payable, essentially, also the income tax expense, I should say, is made up of three elements. It's made up of the tax you owe the tax authorities, the tax payable. It's then made up of changes in both deferred tax liabilities and deferred tax assets. So let's talk about our deferred tax liabilities and our deferred tax assets. This is where the trouble really starts. So deferred tax liability, you can see it's a balance sheet item created when tax payable is less than the income tax expense due to temporary differences. What we're really saying is because taxes payable now are lower than the income tax, what we're doing essentially is we're paying less tax now, but because it's due to temporary timing differences, we're going to pay more tax in the future. Now, if we're paying more tax in the future, that's going to lead to future outflows of benefit, and therefore it meets the criteria of a liability. Let's have a look at a deferred tax asset. It's just going to be the other way around. With a deferred tax asset, we're paying more tax now, but less in the future. So notice this time, today, our taxes payable are greater than our income tax expense due to temporary timing differences. So today we're paying more tax, but when that reverses, essentially, we'll pay less tax. And if we're paying less tax in the future, it means less cash outflows, and essentially, therefore, we have an asset. A couple of other terms we need to discuss. Valuation allowance. Now, valuation allowance is inherently linked to deferred tax assets. Remember what we just said on the previous slide, is when the timing difference is reversed with deferred tax assets, you will pay less tax in the future. Now, how do you pay less tax in the future? Well, the key is, of course, you must be profitable in the future. If you're not profitable in the future, you're not going to benefit from paying less tax. Now, what the valuation allowance therefore does is it nets against deferred tax assets, reduces deferred tax assets if we believe there is insufficient future profit to benefit from those deferred tax assets. Carrying value. Now, carrying value, remember, whenever we see this phrase, carrying value, it simply means the balance sheet value of the asset or liability, i.e. what you see in the financial statements, not what you see in the tax returns. Now, again, remember what we're going to simply say here is be very careful that with assets and liabilities, the carrying value, the balance sheet values, is going to be different from the tax return values. The tax return values we're going to refer to as the taxable base of assets and liabilities. Okay, we could see both deferred tax liabilities and deferred tax assets on the balance sheet. Remember, back in our accounting framework, we were not allowed to offset assets and liabilities. So you don't show the net asset or the net liability. You show deferred tax liabilities separate, deferred tax assets separate. Under IFRS, notice both deferred tax liabilities and assets are non-current. Under US GAAP, deferred tax liability and deferred tax asset is going to have to be split between current assets and liabilities and non-current asset and liabilities. In other words, the amount that will reverse in the next period will be sitting in current assets or current liabilities. The amounts reversing in more than one period will be sitting in non-current. Okay, let's have a look at some differences in accounting and taxable profit. Certainly, you could have revenues and expenses recognized in different periods for accounts and tax return purposes. Now, this is our classic cause of a temporary timing difference. The same amount, remember, goes through the financial statements just in different periods. Good example of this is our warranty expense. In the accounts, due to the accruals method, you have to account for the warranty expense at the time of sale. Remember, warranties are to do with fixing faulty goods within a fixed period. So under the accruals method that says match costs against revenues, you estimate the warranty expense and account for it at the time of sale. Now, of course, the tax authorities are never going to allow you to deduct estimated costs in your tax returns. So the tax authorities say, no. You wait until you physically incur the cost of repairing faulty goods, then you put it through your tax returns. We also get differences due to carrying values of assets and liabilities differing. Okay, now we've got to be careful here. We call it a carrying value when it's in the financial statements. We call it a tax base when it's in the tax returns. So what we're really simply saying here is the carrying value of an asset, let's say plant, property and equipment, in the balance sheet may be very different from the tax base of the asset for tax return implications. A good example of this is caused by depreciation. Now, essentially, depreciation, as we've seen, for the accounting purposes, there's a whole load of subjectivity. First of all, you get to choose what type of depreciation to use. Are you going to go accelerated? Are you going to go straight line? And then, of course, you've got the accounting estimates, such as how long you're going to use the asset for, its useful economic life, and, of course, its salvage value at the end of its life. Now, all of this is subjective, very subjective. And that means, of course, you could manipulate your depreciation calculation to manipulate depreciation and therefore affect, essentially, your profits. Therefore, the tax authorities are not going to allow accounting depreciation in the tax returns. They don't like that level of subjectivity. What they're going to do is take out accounting depreciation and replace it with their own official version of depreciation. Number one, they use a declining balance method. Okay, so they don't give you a straight line, you get no choice. They're going to apply a declining balance method. Number two, they assume zero salvage value at the end of the asset's life. And number three, they tell you the life of your asset according to different classes. So, for example, you buy an asset, you look up that asset class, and it tells you, therefore, what the life is for tax reporting purposes. So notice, therefore, that in the tax returns, all of the uncertainty, all of the subjectivity and judgment regarding depreciation is removed. Again, depreciation, the differences between accounting depreciation and tax return depreciation are going to be a classic source of temporary timing difference. Notice specific revenues and expenses not recognized for tax or accounting purposes. So typically this tends to be tax-exempt revenue or tax-exempt expenses. So it goes through the accounts, but it never goes through the tax returns. Now this is a cause of permanent timing differences. And remember, permanent timing differences do not cause deferred tax. Tax loss carry forwards are going to affect your tax expense, remember. If you've got negative taxable income in previous years in your tax returns, you can roll that forward to offset against future taxable income in later years and as a result pay less tax. Gains and losses on asset disposals, again, are going to be calculated differently for tax and financial statements. For tax returns, they're looking at capital gain. In other words, they're looking at a sales price compared to purchase price, and therefore trying to work out whether you've made a profit or loss. In the financial statements, it's very different. They look at sales proceeds compared to the balance sheet carrying value at the time of disposal. Okay, so our next LOS asks us to explain the causes of deferred tax. So we've got deferred tax liabilities and deferred tax assets here. With a deferred tax liability, the key thing to note is essentially you're paying less tax today, but because it's a temporary timing difference, when it reverses, you'll pay more tax in the future. So notice today, your tax deduction is greater than your accounting expense. In other words, your taxable income is lower than pre-tax income, so you're paying less tax. But this greater tax deduction today is at the expense of lower tax deductions in the future. In other words, the tax deduction in future periods will be smaller than the accounting expense, meaning your taxable income will be higher in the future, and as a result you will pay more tax. Now, a deferred tax asset is just going to be the flip side of this. With a deferred tax asset, we're paying essentially more tax now, but we're going to pay less tax in the future. Okay, so today our tax deduction is smaller than the accounting expense. Okay, now if our tax deduction is smaller, that means we've got greater taxable income than pre-tax profit, so we pay more tax. But of course, remember, it's temporary timing differences, so this is going to reverse in the future. So in the future, the tax deduction is going to be greater than the accounting expense, meaning we have lower taxable income, and as a result, we pay less tax in the future. So the key mantra to take into the exam is the deferred tax liability, less tax now, more tax in the future. Deferred tax asset, more tax now, less tax in the future. And it's all due to temporary timing differences. So again, here we've got a very kind of easy and quick example essentially here. What we're seeing here is our tax returns and our financial accounts. We've got the same revenue figures here, note, but the depreciation is different in the two. Depreciation in the tax returns is $100, depreciation in the financial accounts is $50. So we've got lower taxable income compared to pre-tax income. Because we've got lower taxable income, our taxes payable are going to be less than the tax expense. In other words, we're paying less tax now, but we will pay more tax in the future. Okay, so in other words, when we look at that example, you can see that our tax expense, our tax expense is $40 on the income statement, whereas in the tax return, it's only $20. Our taxes payable is $20. The difference, remember, between the tax expense in the accounts and taxes payable in the tax returns is deferred tax. Now, in this case, it's going to be a change in deferred tax liability. So, in fact, the tax expense is made up of two elements. It's made up of $20 tax payable, and in this case, $20 representing an increase in deferred tax liabilities. Now, note as well, when we calculate our deferred tax liabilities, we are meant to be using the tax rates when the timing differences reverse. Now, of course, unless you've got a crystal ball, you're not going to know what that is. So typically we use today's tax rates unless we know tax rates are going to change, and then make an adjustment to deferred tax liabilities and assets if tax rates change. Now we move on to tax bases. Now the LOS here says determine the tax base of an asset. Now be careful. When we say tax base of an asset, we're saying an asset in the balance sheet. We're not necessarily talking about deferred tax assets at this point. So actually, in fact, we might find that an asset could give us a deferred tax asset or a deferred tax liability. But we're talking about an asset in the balance sheet, so be very careful. Okay, so the tax base of an asset is the amount deductible for tax purposes in future periods as economic benefits are realized. What does that mean? It simply means the amount of the asset that will go through in future tax returns. Now, what they then simply say here is the tax base may not equal the carrying value due to cumulative differences. In other words, the tax base of an asset won't necessarily equal the balance sheet value. Remember, balance sheet value, carrying value. And what is the difference between the two? Well, the difference between the two are the temporary timing differences. So we can compute a deferred tax asset or deferred tax liability by looking essentially at the difference between carrying value and the tax base of the asset times the tax rate to get our deferred tax asset or liability. Now again, I don't want you to worry about that too much right at this second. We're going to see a numerical example where we'll see the tax bases being computed in just a little while. Notice with non-taxable benefits, the tax base and carrying value will be the same. In other words, if we have permanent differences, because they go through the accounts but never go through the tax returns, then essentially you have the same tax base and carrying value, so you have no deferred tax. Again, it comes back to this idea that it's the temporary timing differences that cause deferred tax, not permanent ones. Let's have a look at a liabilities tax base. A liabilities tax base is slightly different from an assets tax base. With an asset, the tax base was simply the amount that would go through future tax returns. A liabilities tax base is the balance sheet amount, i.e. the carrying value, less the amount that will go through future tax returns. Okay, now again, the difference between a liabilities tax base and a liabilities carrying value is due to the temporary timing differences. Okay, again, when we say liabilities tax base here, it's key to point out we're talking about a balance sheet liability, not necessarily a deferred tax liability. Now, there is one liability that is rather different, and that's when we're talking about revenue received in advance. Now, remember, revenue received in advance is when your customers pay you, but you have not yet met the revenue recognition criteria, so you can't record the sale yet. Now, notice here, it says here, the tax base of revenue received in advance is the carrying value, i.e. the balance sheet value of the liability, minus the amount of revenue that will not be taxed in the future. Now, typically, this will be the same as the carrying value, giving us a figure of 0. Why? Why won't we be taxed in the future? Well, it's because the tax authorities tax you at the time of the receipt of the cash from your customer. So in other words, if your customers pay you in advance, you get taxed on that cash when you receive it, not when you record the sale, essentially, in your income statement. So it's a bit of an oddity, that one, so watch out for that. Right, we now move on to our big LOS that says calculate. Calculate deferred tax assets and liabilities, tax expenses, carrying values, etc. So this is going to be a big one. We're going to start off with deferred tax liabilities. So let's have a little look at our example. So our firm has acquired an asset for $21,000 with a 3-year useful life and 0 salvage value. Asset's going to generate $16,000 of revenue for 3 years, and the tax rate is 30%. The firm is allowed to depreciate the asset using double declining balance for tax purposes, but it has to use straight line in the accounts, and we need to compute the tax implications. Well, let's have a quick start on this. First things let's have a look at is the tax returns. So we've got our revenues in there, $16,000 every year, 1, 2, and 3. And then we're going to have our depreciation. Now, our depreciation is calculated double declining balance. So we're going to have $14,000 in the first year, $4,667 in the second year, and $2,333 in the third. Okay, so there's our depreciation. Now, remember, we take the revenue less the tax allowable depreciation to give us our taxable income. Remember, it's the taxable income on which we're going to be assessed. So we've got taxable income in the first year of $2,000, in the second year $11,333, and in the third year $13,667. So you'll notice, simply due to the accelerated depreciation measure, our taxable income is going to increase over time as tax allowable depreciation falls over time. So we then work out our tax payable simply by taking the statutory tax rate, which in this case is 30%, and applying it to taxable income. So 30% of 2,000 gives us 600, 30% of 11,333, 3,400, and 30% of 13,667, 4,100. So notice, simply due to the usage of accelerated depreciation in the tax returns, our tax payable is increasing as the tax allowable depreciation drops off. Remember, tax payable, what you actually owe the tax authorities. Okay, let's move on to our financial accounts. Now, we've got our revenue figures there, 16, 16, 16. Then we're going to have our depreciation, and remember, we were told to use straight line in the accounts with 0 salvage value. So our asset cost $21,000, so we're simply going to have depreciation of $7,000 per annum. Notice we've now got a pre-tax income of $9,000, $9,000, $9,000. Now, because we've got no permanent timing differences in this example, we can take a shortcut to get our tax expense. We can simply take the statutory tax rate and apply it to our pre-tax income, i.e. 30% of 9,000 is going to give us 2,700 each year. Now, what I would stress here is that is very much a shortcut. It wouldn't work necessarily in the real world because of permanent timing differences being involved, and we're ignoring those in this example. We don't have any permanent timing differences. So let's talk about that tax expense, therefore. Now, our tax expense is made up of tax payable, and in this particular example, change in deferred tax liability. So let's take year one. Tax payable, as we saw on the previous slide, was 600. So of that 2,700, 600 of it is tax payable. Now, of course, what that means is 2,100 must represent the change in the deferred tax liability. And in fact, we can see that 2,100 is the deferred tax liability. So the two together gives us our 2,700. Now, in year two, our tax payable was 3,400. Now, given the tax expense is only 2,700, that must mean we have a decrease in the deferred tax liability. Remember, tax expense is tax payable plus or minus the change in the deferred tax liability. So given that tax payable was 3,400, the change in the deferred tax liability must be minus 700. And notice, therefore, our deferred tax liability is decreasing in the balance sheet by 700 down to 1,400. And in the third year, our tax payable was 4,100, which means, given that we have a tax expense of 2,700, the change in the deferred tax liability must have been minus 1,400. So in fact, the deferred tax liability has reduced down to zero over its life. And critical here that you pick up on the tax expense being tax payable plus the change in deferred tax liability. So in year one, the deferred tax liability was created, so 2,100. In year two, it reduced by 700, and in year three, it reduced by 1,400. Okay, now as we said, we've taken a bit of a shortcut approach there, which will probably work in most exam questions. But let's have a look at the detailed maths of what's really going on behind this. Okay, now what we're really trying to do on this slide is highlight the fact that it's all to do with timing differences. So let's have a look at the source of those timing differences. Now in our example, the timing differences are the difference between accounting depreciation and tax return depreciation. So notice in year one, the accounting depreciation was 7,000, the tax return depreciation was 14,000. So I always do accounting depreciation minus the tax return depreciation, so I've got a difference of 7,000. If you take the tax rate, 30%, and you apply it to that difference, you've then got the change in your deferred tax liability for the first period, 2,100. Now we know that the tax payable and change in deferred tax gives us our tax expense. Our tax payable, we knew in year one, was 600. The change in the deferred tax liability is 2,100, giving us a tax expense of 2,700. Let's look at year two. Well, the accounting depreciation is still going to be 7,000, but of course, this time the tax return depreciation is 4,667. So notice this time we have a positive difference between the two. So when we take our positive difference and multiply by the statutory tax rate of 30%, we get 700. So notice this time the deferred tax liability is decreasing by 700. So when we look at our tax expense, we've got the 3,400 tax payable, the $700 decrease in the deferred tax liability, giving us a tax expense of 2,700. Let's look at year three. Year three, again, accounting depreciation 7,000. This time tax return depreciation 2,333, and therefore a timing difference of positive 4667. 30% of this gives us the change in the deferred tax liability, positive $1,400. So the deferred tax liability is decreasing by $1,400. Now, what I really want to point out really at this stage, if I can do it using my highlighter, which is never the easiest thing to use on this screen, notice that here, there we go, we have our timing differences. Notice it was created at 7,000 and then reversed at 2333 and 4667. In other words, if you were to add across that line, it comes to 0. We've got temporary timing differences. The timing differences is created in year 1 and it reverses in years 2 and 3. Okay, let's just finish this off then. So tax payable in year 3, I think that was 4,100. The reversal of the deferred tax liability, positive 1,400, giving you your tax expense of 2,700. Now, I want to look at an alternative method of doing it. Let's come back to this idea of the tax base. So this should give us exactly the same numbers. In fact, notice it does straight away. But notice, by looking at tax bases compared to carrying value, we get the deferred tax liability itself rather than the change in the deferred tax liability. So note that what we're getting here is the actual deferred tax liability, whereas previously what we had was the change in the deferred tax liability when we did it the other way. Okay, so look at the tax base. Remember, what the tax base represents is the amount that will go through in future tax returns. So in year 1, what is the amount of the asset that will go through in future tax returns? Well, if you just flick back to your tax reporting, you've got tax allowable depreciation of 4667 in year 2 and 2333 in year 3. So in other words, the total amount that will go through in future tax returns is $7,000. Compare that to the balance sheet carrying value of the asset in year 1. Well, at the end of year 1, we bought the asset and it cost $21,000, and we've got 1 year of accounting depreciation of $7,000. So therefore, the carrying value, i.e. the asset's net book value, cost less accumulated depreciation, would be $14,000. Now notice then, if we take tax base less carrying value, we get our difference, $7,000. And if you take 30% of $7,000, that immediately gives you your deferred tax liability in year 1 of $2,100. Let's look at year 2. The tax base would represent the amount of the asset still to go through in year 3. And in year 3, per our tax returns, $2,333 of depreciation goes through in year 3. So that is the tax base of the asset at the end of year 2. The carrying value of our asset at the end of year 2, well, again, we had a cost of $21,000. We've now had 2 years of depreciation, straight line of $7,000. So cost, $21,000, accumulated depreciation $14,000, giving us a balance sheet value of $7,000. Again, if we do tax base less the carrying value, then essentially we get the difference of 4667, 30% of that, and that gives us the deferred tax liability that would be sitting in year 2's balance sheet, $1,400. So notice the change in deferred tax liability between year 1 and year 2, $2,100 in year 1, $1,400 in year 2, we've got a change of $700. Then finally in year 3, notice the tax base is 0 because there's no depreciation going through the tax returns after year 3, and the carrying value is 0 because the asset is now fully depreciated. So there's no timing difference and therefore no deferred tax liability. So notice between year 2 and year 3, we have a reversal of the deferred tax liability of $1,400. Let's turn our attention now to looking at the treatment of a deferred tax asset. Now, what we're going to do is look at a warranty example here. So we've got a firm that has $8,000 of revenue for 3 years, and the firm has estimated its warranty expense to be 12.5% of sales. The actual expenditure of $3,000 to meet warranty claims was not made until the 3rd year. Now, remember in the accounts, because of the accruals process, we're going to have to match the cost against revenues. So in other words, we'll have a warranty expense that matches against each year's sales. However, in the tax returns, they're never going to allow us to deduct estimated future expenses. So instead, of course, we deduct the $3,000 when it was actually incurred, i.e. in the third year. Okay, let's look at our tax returns. So $8,000 of revenue each year, repair cost, nothing in year 1, nothing in year 2. Wait until you physically incur the cost, and then under modified cash accounting, we record. So $3,000. So notice that's giving us taxable income of $8,000, $8,000, and of course $5,000. Tax payable at 30%. Well, 30% of $8,000, $2,400. 30% of $8,000, $2,400. 30% of $5,000, $1,500. Now let's turn our attention to our tax returns. Our accounts. So our financial accounts, financial statements, $8,000 each year. Warranty expense. Now, because of the accruals process, we're going to record at the time of sale. So 12.5% of $8,000 is going to give us a warranty expense of $1,000 each year. The tax expense is going to be made up of two elements. It's going to be made up of tax payable, but then also the change in deferred tax assets. Now remember, if deferred tax assets increase, they reduce the tax expense. If deferred tax assets decrease, then of course they increase the tax expense. Now again, because we've got no permanent timing differences in this question, we can take a cheaty shortcut and just take 30% of our pre-tax income to get our tax expense of $2,100 each year. But now let's just talk about that in a little bit more detail. Of that $2,100, what's it made up of? Well, we know that tax payable in the tax returns was $2,400 in year 1. So the $300 difference must be an increase in a deferred tax asset. So notice tax payable was $2,400, so we have a deferred tax asset of $300, the difference between the tax expense and tax payable. Well, in year 2, we had $2,400 tax payable compared to $2,100 as our tax expense. So again, we've got a further timing difference of $300 in our tax returns. So the deferred tax asset is increased by a further $300 to $600. Now let's have a look at year 3. Tax payable was $1,500, but notice we've got a tax expense of $2,100. So this time it must be a reduction of a deferred tax asset. So notice our deferred tax asset falls from $600 in year 2 to 0 in year 3. And that's why our tax expense is $600 greater than tax payable. Remember, increase in deferred tax asset reduces tax expense, decrease in the deferred tax asset increases the tax expense. Okay, here's the proper mechanics behind it. So again, looking at our timing differences, there's the accounting expense, 1,000, 1,000, 1,000, and there's the tax return, 0, 0, 3,000. So when we look at our timing difference, accounting expense less tax return expense, we end up with essentially 1,000, 1,000, and essentially 2,000. So notice, if you add across again, our timing differences, they're created and then essentially they reverse. So in other words, if we add across, and that's my terrible attempt at a plus sign, we get a big fat 0. So timing differences are created and then reverse. Remember, it's temporary timing differences that cause deferred tax. Okay, so if we take our timing difference in year 1, $1,000, take the statutory tax rate, 30%, we get the change in the deferred tax asset of $300. Notice the tax expense is made up of the tax payable plus the change in the deferred tax asset. Of course, plus if it's a deferred tax asset decreasing, minus if it's a deferred tax asset increasing. So because our deferred tax asset is increasing in year 1, it's going to reduce the tax expense. So notice tax payable minus the increase in the deferred tax asset gives us $2,100. Exactly the same in year 2. You've got a timing difference of 1,000, 30% statutory tax rate, giving you the change in the deferred tax asset of $300. So remember what we saw on the previous slide, with a deferred tax asset of 300 in year 1, it increased by a further 300 in year 2. So in other words, the deferred tax asset in the balance sheet in year 2 is $600. Now, of course, the tax payable, $2,400. Straight from the tax returns, the change in the deferred tax asset, it's increased by 300. That will reduce your tax expense. So our tax expense is $2,100 again. So year 3 is the year of reversal here. Notice now our timing difference is negative 2,000. So 30% times minus 2,000 gives us the change in deferred tax asset of 600. In other words, a deferred tax asset in year 1, 300. It increased by 300 in year 2 to be 600. And then it's decreased by 600 in year 3. So ultimately, we've got nothing left, a 0 deferred tax asset. Remember, decreases in deferred tax assets are added to tax payable to get the tax expense. So tax payable from the tax returns, 1,500. Let's add on to that the decrease in the deferred tax asset of 600 to get a tax expense overall of 2,100. Now, we're going to look at the tax base approach here. Now, remember the carrying value is just the balance sheet value. So in year 1, you've had a warranty expense of 1,000. You haven't actually incurred that yet because no goods have been returned. So you'll create a liability in the balance sheet for 1,000. In year 2, you've got a further 1,000 going through the income statement, but you've not incurred anything. So therefore your liability would be 2,000. And in year 3, of course, you get a further warranty expense of 1,000, taking the liability up to 3,000. But then you incur the expense of 3,000, extinguishing the liability, giving you a carrying value of 0. So the balance sheet warranty liability is 1,000, 2,000, and at the end of year 3, 0. Now let's have a look at the tax base. Remember our definition of the tax base here was carrying value minus the amount that would go through in future tax returns. So we start off with a figure of 1,000, and we then say how much of this 1,000 will go through in future tax returns. And the answer is all of it, because it completely goes through or reverses in year 3. So carrying value 1,000 minus the amount of reversal, amount in future tax returns 1,000, we get a tax base of 0. Same with year 2. You've got a carrying value, a balance sheet value of 2,000. So the tax base is 2,000 minus the amount that will go through future tax returns. And we know when we look at our tax returns, the full repair cost goes through in year 3. So all of this 2,000 will go through in future years. So our tax base again is 0. And then in year 3, the liability value is 0. And of course, we then end up with carrying value 0 minus the amount that which will go through in future tax returns, which is 0. So we end up with a tax base of 0 as well. So notice, therefore, that carrying value less tax base gives us our difference, positive 1,000 in year 1, positive 2,000 in year 2, and nothing in year 3. Take your tax rate, 30% times that difference, and that gives you a deferred tax asset. Remember, this gives you deferred tax asset rather than change in deferred tax asset. So 300 in year 1, 600 in year 2, and nothing in year 3. In other words, the deferred tax asset increases by 300 between year 1 and year 2, and it reverses by 600 in year 3. Okay, so it says the liability method for deferred taxes. Deferred tax assets and deferred tax liabilities are based on differences that are expected to reverse. We clearly saw that in our example. We had timing differences in the first few periods, and they reversed in later periods. Now, this then gets a little bit complicated, because essentially if you create your deferred tax asset at one tax rate, but the tax rate then changes before it reverses, then you're going to need to make adjustments, otherwise it won't reverse correctly. Now notice, therefore, deferred tax assets and deferred tax liability values are adjusted for changes in tax rates in the period when the differences are expected to reverse. Okay. Now, essentially, this is going to be a little bit more complicated. And I'd have to say here, changes in tax rate for deferred tax assets, deferred tax liabilities get the basics first. Once you feel totally comfortable on deferred tax asset, deferred tax liability, and looking at tax bases to compute them, then move on to this. If you're not comfortable on this, then the answer is B in the exam, move on. I mean, it's unlikely that you're going to see changes in tax rates and how they affect deferred tax assets and liabilities. Don't spend too long studying this material at the detriment of other material. Okay, deferred tax assets, of course, are adjusted with valuation allowances. We've mentioned this before as well. We said, look, when a deferred tax asset reverses, you're going to pay less tax. Therefore, you need to be profitable when it reverses to benefit from paying less tax. So if you're not expected to have sufficient profits to benefit from the deferred tax asset, then we reduce the deferred tax asset by the valuation allowance under US GAAP. Okay, so it says evaluate the impact of a change in tax rate and then calculate the impact. I certainly think as a bare minimum you need to be able to evaluate the impact. Okay, in terms of being able to calculate the impacts, again, only if you feel totally comfortable with the basics would I bother with this learning outcome. Now, let's have a look at when tax rates decrease. So in other words, we've created the deferred tax asset or liability at a higher tax rate, and then it reverses at a lower tax rate. Now, what we're therefore saying is, look, when we created, let's take deferred tax liability, for example. When we created the deferred tax liability, it's too big because we created it at a higher tax rate. Therefore, when the tax rate falls, we're going to need to reduce the deferred tax liability. In other words, we're just going to restate it at the correct tax rate. Reduction in deferred tax liability, well, we know reductions in deferred tax liabilities reduce the tax expense. So this would actually give you a lower tax expense. With the deferred tax asset, again, you've created it at too high a rate. So when the tax rate changes, you need to reduce the deferred tax asset. And of course, you would reduce the deferred tax asset, and the reduction in deferred tax assets, we know, increase the tax expense. Okay, let's have a look at when tax rates increase. When tax rates increase, well, essentially, that means we created the deferred tax asset and liability at too low tax rates. So, when the tax rate increases, we're going to need to increase deferred tax liabilities and deferred tax assets. If you increase the deferred tax liability, that's going to increase your income tax expense. If you increase the deferred tax asset, that's going to decrease your income tax expense. Okay, overall, how does it affect the tax expense when a tax rate changes? Well, again, it's going to depend on which factor dominates. Is it the deferred tax liability that dominates or the deferred tax asset dominates, which therefore depends on the relative size of the two. Right, let's now move on to calculate. Okay. So our firm here has acquired an asset for $2,400 with a 3-year useful life, no salvage value. Asset's going to generate $20,000 revenue for 3 years. Double declining balance in the tax returns, straight line in the accounts. Now here's the kicker. In year 1, our tax rate was 40%, but it's going to fall to 35% for years 2 and 3. Now, this means when we create our deferred tax liability, we're going to be creating it at 40%. But when it reverses, it's going to be reversing at 35%. In other words, when the tax rate drops to 35%, we're going to have to reduce our deferred tax liability. Let's look at the numbers. Tax returns, the tax reporting, fairly straightforward. There's the revenue each year, 2020. There's the accelerated double declining balance depreciation, 16,533 and 2667, giving us our taxable income, 4,000, 14,667 and 17,333. Tax payable, well, of course, in year 1, it's simply going to be 44,000 times 40%, so 1,600. In year 2 and year 3, be careful, remember, because the tax rate has now changed. So in year 2, 14,667 times 35% will give us our tax payable of 5,133, and in year 3, 35% of 17,333 gives us our 6,067. Okay, let's have a look at the financial accounts. Okay, so revenue, less straight line depreciation in year 1, 20,000 less 8,000 gives us 12,000. The tax expense, 4,800. Again, let's have a look at how that tax expense is built up. That tax expense, of course, is going to be made up of the tax payable. And our tax payable was 1,600. And the balance, therefore, is the change in the deferred tax liability. So our change in deferred tax liability must be 3,200. Let's look at year 2. You've got 20,000, depreciation of 8,000, pre-tax income of 12,000, but this time our tax expense is 3,800. Now this tax expense now contains a number of different elements. It's going to include the tax payable, and year 2's tax payable was 5,133. It's going to include a correction of years 1's deferred tax liability. Now what is this correction? Well, the correction is we created our deferred tax liability at 40% when in fact it reverses at 35%. So our deferred tax liability in year 1 was too high by 5%. So in fact we're going to get a correction. If we take our 3,200 times 5%, we're going to get a correction essentially in year 2 of 160. And then the other is the normal reversal of the deferred tax liability. Okay, so that tax expense of 3,800 therefore has 3 component elements. Tax payable, correction of the deferred tax liability due to the change in tax rate, and the normal reversal of the deferred tax liability. We'll see that 3,800 in more detail in just a little while. Then, of course, we've got our final period at year 3, 20,000, 8,000 giving us 12,000. The tax expense, 4,200, made up of our 2 elements, tax payable from the tax returns, which was 6,067. The other element must be the reduction in the deferred tax liability, 1,867. So let's have a look at that year 2 and in more detail. So here's our computation. As before. Notice year 1 is the same calculation we did before. The timing difference is the difference between accounting depreciation and tax return depreciation, i.e. 8,000 at 40% gives us a change in deferred tax of 3,200. Note the tax expense is then made up of two elements, the tax payable of 1,600, the increase in the deferred tax liability of 3,200, giving us 4,800. Right, year 2 is the interesting year. Notice our timing difference, 8,000 accounting depreciation, 5,333 tax return depreciation, giving us our difference of 2,667. 35% of that gives us 933. Now the 933 is the reversal of the deferred tax liability, but we've got another element going on here as well. Notice when we look at our tax expense, we're seeing tax payable, 5,133. We're also seeing a correction of 400, a reduction in a deferred tax liability, so it's reducing our tax expense. And then the reversal of a deferred tax of 9,333, giving us overall our 3,800. Now look, we can see now where that timing difference comes from. Oh, that correction, sorry, I should say, comes from. Initially, in year 1, we created our liability at 40%. The timing difference was 8,000. We took 40% of that. We got 3,200. However, had we had clairvoyance, we should have created it at 35% because the tax rate changed in years 2 and 3 when it reversed. So 8,000 times 35% says 2,800. So in year 1, we created a deferred tax liability for 3,200. When due to the tax rate changes in subsequent years, it should have only been 2,800. So what we're going to do is reduce the deferred tax liability by the difference being 400. And remember, reductions in deferred tax liabilities reduce the tax expense. Year 3 is as normal. Now, another way of doing these calculations is to look at the assets tax base. And in fact, I actually think this is a slightly simpler way of doing it. So notice, there we go, there's the tax base of the asset. And now remember, the tax base of the asset essentially represents the amount of the asset that will go through in future tax returns. So if we look back at our tax reporting, tax allowable depreciation for the asset in years 2 and 3 was 5333 and 2667. So in year 1, the total amount of depreciation that will go through the tax returns in years 2 and 3 is 8,000. So that's its tax base. In year 2, the tax base will be the total amount of depreciation that will go through in year 3, which is 2667. And in year 3, of course, the tax base is 0 because all of the asset's value has gone through the tax returns. Now compare that to the carrying value, which is, of course, is balance sheet value. So in year 1, we've got 24,000 minus 1 year's worth of depreciation, 8,000, giving us 16,000. In year 2, 24,000 minus 2 years worth of depreciation, giving us 8,000, 24,000 minus 16. And in year 3, 24,000 minus 24,000 gives us 0. So let's look at the difference being the tax base minus the carrying value. 8,000 less 16,000 gives us 8,000. 2667 minus 8,000 gives us 5333. And 0 minus 0, of course, is 0. Take your tax rate, multiply by your difference. So 8,000 times 40% gives us our deferred tax liability of 3,200. 35% of 5333 gives us our deferred tax liability of 1867. And notice the difference in your deferred tax liability, 3,200 down to 1867, is a change of 1333. This 133 has both elements. It has the correction and the reversal of deferred tax automatically within it. And you can compare that, you can look at that by going back to the previous example. In our previous example, we had a correction of 400 and the reversal of deferred tax of 9333, giving us a change in deferred tax liability overall of 1333. So actually, using tax bases is an easier approach in order to deal with tax rate changes. Phew, the calculations, my friends, are over. Hopefully your brain is still intact. If you're a normal human being, of course, it will not be. I've taught CFA in London classes and in fact throughout Europe for about 10 years now, and I can tell you deferred tax is the one thing that I get the most questions at level 1. Certainly one of the 2 hardest topics, I'd say. Computing CFO using the indirect method, complicated when you're first picking it up. Computing deferred tax, assets and liabilities, very, very complicated topic. You know, which one's more important? I'd say computing CFO is more important because it's going to be the basis of free cash flows in levels in level 2 and 3. Whereas deferred tax, this is a one-off hit at level 1. So expect questions on deferred tax, but don't expect thousands of questions. Right, permanent differences. Let's move on. It says distinguish between temporary and permanent. Well, we've kind of done this already. We've said a temporary difference is where the same amount goes through the tax returns and the accounts just in different financial periods. Whereas permanent difference, it goes through the accounts, but it never goes through the tax returns, because it's exempt. Okay. Now, it will result in your effective tax rate differing from your statutory tax rate, whereas temporary timing differences do not cause a difference between the effective rate and the statutory rate. Remember, we said when we were doing those numerical examples, if there are permanent timing differences kicking around, you can't simply take pre-tax income times tax rate to get the tax expense. Okay, in other words, let's have a look at what the effective tax rate is here. Income tax expense divided by pre-tax income. Okay. Now, of course, the idea is the pre-tax income is affected by the permanent differences. They're included in that, but the income tax expense is not affected by the permanent differences. So therefore, you get a difference between the effective rate and the statutory rate. You do not get that, remember, with temporary differences. This one's a little bit of a bizarre one. Carrying amount does not equal tax base at initial recognition. Now, with our assets and liabilities that we've seen in our previous examples, i.e. the depreciation and the warranty, the carrying amount of the asset and the tax base of the asset were identical at the time the asset was purchased or the liability was purchased. However, we're saying, what happens if they're different? Now, the classic reason why they may be different is government grants for asset purchases. Okay, so you've got a government grant. Now, of course, what that means is the company is paying less to acquire the asset, giving you a lower carrying value. Now, you should be aware that grants are not deductible from the asset's tax base. So the tax base of the asset will be greater than the carrying value. Now, theoretically, if tax base is greater than carrying value, that should lead to deferred tax assets. However, the rules say here, no, you do not create a deferred tax asset, even though the carrying value is less than the tax base. So we've got this rule here that says no deferred tax is accounted for if there is no impact on accounting or taxable profit at the time of transaction. Let's try and decompress that and make some sense of what that sentence means. What it means is, if there is a difference between carrying amount and tax base at initial recognition, but that difference has not gone through either the income statement or the tax returns, then you do not create a deferred tax asset or liability. Look, true, I just remember grants don't create deferred tax assets. Simple as that. Now we move on to look at business combinations. So we're really talking about acquiring subsidiaries and joint ventures and associates here. First of all, we should be aware there is no deferred tax on goodwill or any goodwill impairments. We do not have deferred tax on goodwill, so it won't create deferred tax assets or liability. However, you may get deferred tax on acquisition resulting from fair value adjustments of assets and liabilities when you acquire a subsidiary. Okay, that kind of means we need to know what happens when you acquire a subsidiary, which isn't really until we get to level 2. Just to give you a kind of heads up on what actually happens here. When you acquire a subsidiary, you take their balance sheet and you adjust all of the assets and liabilities from balance sheet carrying values to fair values at the date of acquisition. And of course, fair value acquisition may differ from carrying value. So we will need to adjust the carrying value of the subsidiaries' assets and liabilities that we've acquired. And as we adjust the carrying value, it means there's going to be a difference between carrying value and tax bases, creating essentially deferred tax assets and liabilities. Look, what do you need to know for the exam? Fair value adjustments when you acquire a subsidiary can create deferred tax assets and liabilities. End of story. Now, there's another issue when you have subsidiaries, joint ventures and associates as well, and that's to do with the recognition of earnings versus dividends. Because what we're going to see is in our income statement, we're going to see earnings. Now, if you have a subsidiary, you just bring in all of its earnings. If you've got an associate, you bring in your share of its earnings, or a joint venture, your share of its earnings. So if you own 30% of it, you bring in 30% of its net income. But what do we get taxed on? We don't get taxed on our share of its earnings for group companies. We get taxed on the dividends in our tax returns. Now, of course, unless a company pays out all of its earnings by way of a dividend, typically dividends are less than net income. Therefore, we've got net income going through the income statement, but dividends going through the tax returns. Okay, so we've got less going through the tax returns, which means essentially we're going to be paying more or less tax. Well, we're going to get deferred tax liabilities. And remember, deferred tax liabilities are caused by paying less tax now, but more tax in the future. Remember, we're talking about income here. The dividends income that we're receiving in the tax returns is less than the net income, or our share of net income, that we're showing in the accounts. So you typically get deferred tax liabilities due to those timing differences, unless the parent controls the timing of the reversal. Now, of course, this is only ever going to reverse if at some point the subsidiary pays out all of its retained earnings by way of a dividend, so that the total of earnings equals the total of dividends. Or the timing difference is unlikely to reverse. In other words, dividends will remain smaller than earnings. Okay, so in other words, I think really what they're saying is, here, it's unlikely that you'll see deferred tax liabilities. Unlikely that you'll see deferred tax liabilities, especially for subsidiaries, because by definition, the parent company should be controlling the dividends in that particular case. With joint ventures and associates, well, joint ventures is sharing of control, so surely they have some control of the timing of reversal. And with associates, they only have an influence, so it's unlikely that they're going to have control. However, it's very unlikely that the associate will pay out all of its retained earnings by way of a dividend at some point, so it's unlikely that the timing difference will reverse. So I would tend to say it is unlikely that you will see deferred tax liabilities in the real world caused by the differences between earnings in the accounts and dividends in the tax returns. Let's turn our attention to the valuation allowance. We've talked about this already. The valuation allowance only refers to deferred tax assets, and you only see it under US GAAP. Remember, when a deferred tax asset reverses, you pay less tax. Therefore, you need to be profitable in the future in order to benefit from paying less tax. If you're not going to be profitable, you're not going to benefit from the reversal of the deferred tax asset, and therefore it is not an asset because it doesn't give you any benefit, inflow of benefit in the future. Okay, so that's all the valuation allowance does. It nets against the deferred tax asset. The other side of the transaction appears in the income statement. Now notice we're saying on our third bullet point here, we could manipulate valuation allowances to manipulate earnings. Okay, increase the valuation allowance, that will decrease your net income. Decrease the valuation allowance, that will increase net income. Last bullet point says, may affect analysts' assumptions regarding future earnings, because if we see valuation allowances, the company is telling us they do not expect the future to be hugely profitable, and as a result, they're not going to benefit from deferred tax assets. So the analyst thinks, well, hang on a second, here's the company saying it's not going to be profitable in the future, I better build that into my forecast of future earnings. We've got a compare LOS that says compare deferred tax items. Well, all that we're really talking about here is disclosure in the accounts. The disclosure, you'll notice that you'll see changes in deferred tax liabilities per each source. Okay, so it might be to do with depreciation, warranty expenses, etc. Same with deferred tax assets, and you also get disclosure of the valuation allowance. Analyze the required deferred tax disclosures. So, we've kind of said this on the previous slide. You're going to see deferred tax liabilities and assets, any valuation allowance, and any change in the valuation allowance. You're going to see unrecognized deferred tax liability for undistributed earnings on subsidiaries and joint ventures. Aha. So this goes back to the slide previously. Unrecognized means not in the balance sheet. So in other words, if you do have subsidiaries and the parent does control the timing of reversal, or it's unlikely the difference will reverse, whilst we don't record the deferred tax liability due to earnings versus dividends in the accounts, we would disclose it in the footnotes. The current year effect of each time of temporary difference. So in other words, the change in deferred tax assets and liabilities split out for each temporary timing difference. The components of income tax expense, which of course will be the tax payable, the change in deferred tax assets, the change in deferred tax liabilities. Tax loss carry forwards and credits. In particular, carry forwards are important because they will reduce future tax expenses. And notice the company also needs to produce a reconciliation between its income tax rate, the statutory rate, and its effective tax rate. Okay, now that's quite going to be quite complicated. That's going to show up the permanent timing differences. And of course, for multinational operations, you're going to be taxed at lots of different rates according to where your subsidiaries are based, and that would show up as well. So that could be quite a complicated little reconciliation. More disclosures. Be aware of differences in tax reconciliation between periods. Yes, we want to know why things have changed from period to period. Consider the firm's growth rate and capital spending when determining whether temporary differences due to accelerated depreciation will reverse. Now, this is a good point. We typically got a reversal when we were looking at a fixed asset, plant, property and equipment, because we had straight line depreciation in the tax return, in the accounts, and accelerated in the tax returns. And we know with accelerated depreciation starts off large and then gets smaller over the life of the asset. However, if you were to continually add to your fixed assets, in other words, fixed asset based plant, property and equipment was going to grow, then the accelerated depreciation in the tax returns would always be bigger than the straight line depreciation in the accounts, and as a result, the deferred tax liability would not reverse. Okay, in other words, deferred tax liabilities caused by the difference between straight line and accelerated depreciation may not reverse if the company continues to expand its plant, property and equipment, i.e. its growth rate and its capital expenditure continues to increase. Once the growth in capital expenditure diminishes, then eventually that accelerated depreciation is going to drop, and then the timing difference reverse. Look for cumulative differences due to asset impairments and post-retirement benefits. Yeah, an asset impairment is like a massive depreciation charge. It has a huge impact on carrying value, but it's not tax allowable. Okay, so you tend to find that asset impairments cause deferred tax liabilities to reverse because it massively reduces the carrying value of the asset in the balance sheet. Post-retirement benefits, again, typically we're going to see an impact here because in the income statement we're going to have a pension expense, but in the tax returns we'll have the employee's contribution into the plan, and the two won't be the same. Now, typically the contribution into the plan is lower than the pension expense, meaning essentially we've got more going through the accounts of the tax returns. Okay, so meaning higher taxable income now, but lower taxable income potentially when that reverses. Higher taxable income now, pay more tax now, but less in the future. So post-retirement benefits, i.e. defined benefit pensions, typically create deferred tax assets. Restructuring charges can create deferred tax assets because they go essentially through the income statement when in the year the decision is made, but they don't go through the tax returns until you incur the expenditure. A bit like our warranties, exactly like our warranties. Okay, so essentially you get higher taxable income now, but lower when the expenditure is actually incurred, creating deferred tax assets. Almost there, guys, almost there. Analyst treatment of deferred tax liabilities. If the differences are expected to reverse in the foreseeable future, we leave the deferred tax liability as a debt item when we're computing our leverage ratios. Remember, the CFA Institute used total debt as a definition, where total debt is all long-term liabilities plus any interest-bearing short-term liabilities. So if you're expecting the deferred tax liability to reverse, it will lead to cash outflows, and therefore we leave it as a debt instrument. If the deferred tax liability is not expected to reverse, now again, typically these are deferred tax liabilities caused by depreciation, and it's typically where you have a company that is expected to grow for the foreseeable future and increase the growth in its capital expenditure. Now remember, we said that will keep accelerated depreciation in the tax returns greater than straight line depreciation in the accounts, stopping the deferred tax liability reversing. Now, what they say is if it's not going to reverse for the foreseeable future, it's not leading to outflows of benefits, it's not truly a liability. So the accountants will leave it as a liability, but the analysts may take it out of liabilities and, to keep the balance sheet balancing, increase stockholders' equity. So liability is lower, stockholders' equity higher. Notice it says when the amount and timing of future tax payments from reversal is uncertain, eliminate it from both debt and equity. I'm a bit dubious about that one. If you eliminated it from both, then your balance sheet will not balance. Right, key differences between IFRS and US GAAP, which is our last LOS, asking us to identify. Well, of course, IFRS, you can revalue PP&E and intangibles. Under US GAAP, you can't. So under US GAAP, when we look at deferred tax liabilities caused by depreciation, the carrying value is based on historic cost. Whereas under IFRS, it might not. The carrying value might be based on fair value. So you might get bigger impacts. So that's certainly one. Undistributed profits from subsidiaries, associates and joint ventures is treated differently between the two. Yeah, have a little awareness. Deferred tax assets, IFRS only recognises the asset that is likely to be recovered. Look, US GAAP has a similar treatment. They have the full recording of the deferred tax asset, but then they net the valuation allowance against it, giving you the same overall figure on the balance sheet that you would see under IFRS. Different way of arriving, but same figure in the end. Then finally, presentation. US GAAP, of course, splits deferred tax assets and liabilities between current and non-current. Next period's reversal goes into current. Reversals after more than one period go into non-current. IFRS, the full amount goes into non-current assets and liabilities, regardless of the timing of the reversal. Whew. So, I said deferred tax was going to be difficult. It is a stinker. Remember, get the basics. Get the basics, read through, move on with your studies. You can just spend more time in this area than it's worth, okay? Come back maybe on revision and try and get the extra marks, but not right now. You've got to progress with your CFA studies. Right, let's finish off with a question. A deferred tax asset would most likely be created by using straight line depreciation for the financial accounts and accelerated for the tax returns? Yeah, no. That's more likely to create a deferred tax liability. Remember, more expense in the tax returns in the earlier years compared to the accounts gives you a lower taxable income, meaning essentially you pay lower taxable income. You pay less tax now, but more tax in the future. Okay, so that would create, of course, deferred tax liability. So it's not A. Differing treatment of warranty expenses for taxes and financial reporting. Now that sounds good, of course, because the expense goes through the tax returns when it's incurred, but the accounts at the time of sale, giving you higher taxable income in the earlier years, meaning you pay more tax now, but less on reversal, a deferred tax asset. Sounds like B. Utilising existing tax loss carry forwards to reduce a given year's tax payable. Well, again, essentially, that's unlikely to cause a deferred tax asset. So the clear one that leaps out is B. Well done.